Welcome to part 3 in our series on the financial sector. In this video, we will be connecting the money market to the rest of the circular flow model. Here is our basic circular flow model. This one doesn't include either the government sector or the foreign sector. We want to keep things as simple as possible for right now. In the first video in this series on the financial sector, we developed the concept of the money market, financial intermediaries that are basically middlemen. The role of the depository institution is to bring together people with an excess of funds that they want to put to work, and people with a shortage of funds who want to buy things now rather than having to wait until they save up enough cash. But there are non-depository institutions as well. These institutions provide brokerage services for people who want to buy stocks and bonds on secondary markets. Stock and bond markets, like the New York Stock Exchange, are secondary markets, markets where previously owned assets are bought and sold. The used car market, for example, is a secondary market. They also provide insurance, that is, they invest your money for you and pay your heirs big time if you die. They also provide financial forecasting, manage your investment portfolio, and provide financial and tax advice as well. Here are the depository institutions, and these are the non-depository institutions. But whether they are depository institutions or non-depository institutions, the money market, which is the financial sector of the economy, includes all financial intermediaries. In the second video of this series, we saw that there are 4 factors that affect the interest rate that a depository institution will charge a borrower. So now, let's hook up the money market to the rest of the circular flow model. But first, let's remember some macroeconomic definitions. Remember, there are many cases where a word is used differently in macroeconomics than it's used in everyday English. One of these is savings. In macroeconomics, savings is anything the household does with its income other than purchase a consumer good or service or pay taxes. So if a household takes its disposable income, that is, its after-tax income, and stuffs it in a mattress or a pillowcase, it is saving. Or if it puts some of its income in a savings account, a money market account, or a CD being a certificate of deposit, a type of savings account. That's savings too. Even if it buys stocks, bonds, mutual funds, or some other investment product, that's savings in macroeconomics. Remember, the money market not only includes banks and other depository institutions, but it also includes brokerage firms, stock and bond markets, and mutual fund companies as well. We usually think of this as investing, but in macro, it's savings. The second term we want to define in a macroeconomics way is investment. Investment in this context means the purchase of capital goods by firms. In everyday English, we might call this business investment, while we would call buying stocks, bonds, and mutual funds personal investment. But here, that's savings, not investment. Investment is spending by firms on goods that produce goods, such as machines, equipment, tools, and buildings. Now, in connecting the money market to the rest of the circular flow, our first flow will be that from the household to the money market. This flow will include depositing money in a bank or some other depository institution, buying stocks on the stock market, buying bonds, mutual funds, anything we might categorize as personal investment. This flow, not surprisingly, we will call savings. Here's the flow from the money market back to the household. This flow will represent money flowing from the money market to the household through personal loans or returns, that is, earnings, on savings. Returns to savings could come in the form of interest income, capital gains, or dividends. Depositors into a savings account, whether it be a passbook savings account, a money market account, or a certificate of deposit, earn interest. After all, these depositors are lenders. Bondholders, who are also lenders, earn interest and potentially capital gains. Capital gains is the profitable sale of an asset. Stockholders can earn capital gains and dividends. These labels on the flow from the money market to the household are as follows. L stands for loans. II would stand for interest income. D would stand for dividends. And CG would stand for capital gains. Now, to understand more about earnings from stocks and bonds, please watch the video on bonds and the 2 videos on stocks, the links to which are in the to-do list in Module 5. A firm can do 3 things with its profits. It can purchase capital goods, either for expansion or to replace depreciated capital. It can pay it out to the owners or the shareholders in the form of dividends or interest to its bondholders, or it can save it. This flow will represent savings by the firm, who also put their excess cash to work. But we'll call it something other than savings so we won't get this flow confused with the flow to the household. Instead, we'll call this flow what the accountants call it: retained earnings. Now, and I saved this one until last for a reason, let's take a look at the flow from the money market back to the firm. We'll call this flow investment. Remember once again, investment in macroeconomics means the purchase of capital goods. And it can also include the purchase of R&D services, research and development. But do you see any capital goods being purchased in this flow? Of course not. But that's because you can't see what's going on in that F box. So, let's take a closer look at that F box and see what's going on. Here it is magnified so we can see what's going on inside. This green line represents the flow coming up from the money market that we will ultimately call investment. For our purpose here, we will say that there are 2 categories of firms that populate this F box. One category includes firms that produce consumer goods. We'll call this box F sub C. That subscript C stands for consumer. Here's another category of firms. The firms in this group produce capital goods, so we'll call that F sub K. The subscript K will stand for capital. We've already used C. Capital goods, remember, are goods that produce goods. Capital goods would include things like tools, equipment, machinery, buildings, etc. Firms in the F sub C box produce widgets and zerks. Firms in the F sub K box produce widget-making machines, zerk-making machines, as well as dump trucks, warehouses, jackhammers, assembly lines, and the list goes on. The firms that produce consumer goods must purchase capital equipment from the firms that produce capital goods. There's the flow of money from F sub C to F sub K to purchase those capital goods. Since investment is defined to be the purchase of capital goods, we'll call the flow of money from F sub C to F sub K to purchase those capital goods investment, or we'll simply label it I. The flow from F sub K to F sub C represents the actual physical good going to the firm. So we'll call this flow the delivery of capital goods. But where does F sub C get the money to purchase capital equipment from F sub K? Answer: it either gets it from its own retained earnings account or it borrows it. Please watch the video on the demand for capital goods by firms. This will explain the circumstances under which a firm would borrow in order to invest. The link to this video is in the to-do list in Module 5. So the firm either takes it out of its own savings account, which is called internal financing, or it borrows it, which is called external financing, but in either case, it gets the funds to invest from the money market. So the money used to purchase capital goods from F sub K comes up from the money market, passes through F sub C, and goes to F sub K. But we can't see what's going on here in our circular flow model because the F box is too small. So we'll just call this green line I and let it represent investment. Here we see the money market completely hooked up to the rest of the circular flow model. Here then is the full circular flow model. Do yourself a favor and see if you can reconstruct this diagram, including the labels, on the back of an envelope. Keep practicing it until you can do it without straining your brain too badly. This investment of a little bit of time and effort will produce huge returns in this class.